Welcome to the Fear and Greed Daily Interview. I'm Sean Aylmer. A key incentive for people to invest in shares is the tax imputation system. Put simply, franking means that a profit earned by a company isn't taxed a second time when it's distributed to shareholders. But now one of Australia's leading investors is campaigning against some of the changes made to the franking credit system in last week's budget. Remember, this is general information only, and you should seek professional advice before making any investment decisions. We've spoken on many occasions to the team from Wilson Asset Management. They manage 8 listed investment companies with almost $5 billion in shareholder capital on behalf of more than 130,000 retail investors. Geoff Wilson AO is the founder, chairman and chief investment officer of Wilson Asset Management. Geoff, welcome back to Fear and Greed.
Thanks, Sean. Good to be here.
Now, in English, take me through the changes in the budget last week.
Yeah, okay, I'll go through the changes. And to me, the biggest thing is the implications for those changes.
Yes. Yep.
And probably we go back a bit further. So, say we go back 3 or 4 weeks ago. Treasury, obviously a new government's in. So Treasury's gone to them and said, hey, look, we need to raise some money to repair the budget. These are all some places you can get some money. One of them was by stopping companies that pay fully franked dividends, if that fully franked dividend is associated with a capital raising of any magnitude, to help pay that dividend before or after the dividend's paid. And they were asking for submissions or commentary, and then the government was going to look at it. So initially, we were nervous then in terms of the government doesn't quite understand what's going on.
Yep.
Yeah, because they're immediately breaking an election promise, or there was something a bit more sinister occurring. Once we saw the budget come out, and then where it said there that companies that do buybacks and allow people to get a fully franked dividend as part of that buyback, the plan is to stop that from occurring. And the difficult thing, and I think I was angry initially.
Right.
I feel actually pity for the government, because I actually think they just don't understand what they're doing. They don't understand the economic consequences of their behaviour, because Paul Keating set this system in place. And I was reading an article he wrote in 2013, and he said, Treasury does not like the franking system, and every 7 years they'll try to change it. And so what you've seen is a new government's come in, and they're having the wool pulled over their eyes. This is obviously Jim Chalmers and Anthony Albanese and the various other ministers, by Treasury, because Treasury don't like the franking system. What Treasury don't understand is the incredible benefits of the franking system. People getting caught up about tax refunds, and I know you mentioned that in your introduction, but it's really how important the franking system is to the financial stability of Australia. And we saw back in the GFC, why did Australia and Australian companies do so well versus the rest of the world? In this tough period that we're going to go through, why will Australian companies do so well versus the rest of the world? It's the Paul Keating franking system. And that's why, because what it does, it encourages Australian companies to pay tax in Australia, to invest in Australia, to employ Australians, and also, normally you're running a company, you've got a decision. Say you want to expand, you can either borrow money and pay interest, which is tax deductible, or you can raise equity. Now, because of our franking system, it makes equity cheaper for Australian companies, where globally companies tend to borrow money and get the benefit of the tax deduction of those interests. And that's why Australian corporates are so well positioned.
So I just jumped in a couple of almost missing links for me. Help me out here. So franking credits are paid on Australian earnings, not overseas earnings.
The tax is paid in Australia. Yeah. So overseas earnings, domestic earnings, if they bring it back to Australia, the tax has to be paid in Australia.
Why does Treasury not like franking?
Well, they don't understand what it does.
Yeah. They just see it as a leakage from the tax system. Is that kind of
as simple as that? Leakage from the tax system. Yeah, that's all. It's one dimensional. And unfortunately, the Labor government doesn't understand the consequences of what they're doing. Effectively, it's like, say you've just had a new house built, and you can't afford to pay the electricity, all the electricity in the new house. You've got a blank fuse board and you don't know which fuses control what. So that's what the Labor government's doing. They're flipping a couple of fuses. What they don't realise, it's just turned off the engine of the house. So to me, that's what they're doing. They're in the process of destroying the franking system. Like a normal company makes, say, $100, pays $30 tax. What they're saying is that other $70, and most listed companies, pay out half the profit they make. Mm-hmm. So they pay out $35 as a fully franked dividend. The other half, that $35, they invest. They maybe invest in their business, invest in their product. Well, the government, by the two moves that they're talking about in the last month, is stopping that $35 to ever be paid out to shareholders, because the only way you can pay that out to shareholders going forward, you can't raise capital, you can't do a buyback. The only way is borrow more money. So they're either encouraging companies to borrow more money and take more risk and pay out those fully franked dividends, or not invest in your business and pay them out as fully franked dividends. Like, they are creating the wrong behaviour.
So every investor gets dividends, but at least anecdotally, the people who will be hit hardest here potentially are retirees, because many of them live on their dividends.
Well, to me, the annoying or frustrating part is, in terms of professional fund managers, we don't participate in those buybacks because we want the highest price possible. Now, in terms of, we'll let our shareholders work out their tax positions. So it's really the people that participate in those, the buybacks or the major beneficiaries of them are the mums and dads. The people that have worked all their life, done the right thing, and they live on their, say, fully franked dividends, haven't gone to the government for support, have their self-managed super funds, or the low-income earners. Like, I'm on the maximum tax rate, 48 and a bit percent. I don't want fully franked dividends because there's only 30% tax paid on it, so I've got to pay the other 18% tax. I'm better off getting the capital gain, and I only pay half my tax rate on the capital gain. So it's not the rich. This is impacting, which annoys me and frustrates me. It's the ignorance of the government not understanding how the system works, having the wool pulled over their eyes by Treasury, and on the other side, the people that are going to get impacted are the self-managed super funds, the low-income earners. Like, if you're on a really low income, then obviously you get the significant benefit of franking credits.
Stay with me, Geoff. We'll be back in a minute. I'm speaking to Geoff Wilson, Chairman and Chief Investment Officer of Wilson Asset Management. It's eating away at the franking system by stealth so far. We've had 2 examples now in the last 4 weeks. Do you expect it to keep going? I mean, where do you think the government's heading on this? Or where do you think Treasury's heading on this might be a better question?
Well, what I'm hoping, and the reason why we are incredibly vocal, I mean, you're aware of the money and effort and resources we committed to the franking campaign, the retirement tax. I think this is retirement tax 2.0. Back in the initial retirement tax that the Labor opposition, which ended up not winning the election in 2019, was trying. From March till the election, so a year and a quarter, we committed significant resources to run a campaign to stop that. And we will commit equally those resources, if not more, to run a campaign to stop this occurring as well. It's still got to get through the Senate, so nothing's cast in stone. And let's hope that the rest of the people that were impacted back then come out and tell the government what they think. You've got to remember, the government's only got a 1-seat majority. So to me, this is the end of their honeymoon. To me, it's really not much has to change. Only a small change will have significant consequences for the government. And what is concerning is, back in 2019, they stopped the individuals with an inequitable strategy, but trying to stop some individuals. Like, if you're in an industry fund, you got the franking. If you went on the pension before the 28th of February 2018, you got the franking. If you happen to be born 3 or 4 days later, then you miss out on the franking. If you're an industry fund, you got the franking. So to me, it was just so unfair and illogical. But they were trying to stop the individuals from getting the franking. Now, this time, they're trying to stop the companies from getting the franking. Now, in terms of, I talked about that example of $100 and that $35 that you invest in your business and $35 you pay out in dividends. We're still running the numbers, but it looks like that's $30 billion a year that's not paid out. It won't be paid out in fully franked dividends. So what that means is, I think that probably the government, the next move, and there was a lot of talk that this would happen, is really trying to decrease the size of self-managed super funds. So there's, again, go back to the individual, try to make the franking less valuable to them, but they can use less franking. And then what really concerns me is, what happens eventually. And, like Paul Keating mightn't still be alive when this happens, but he'll turn in his grave if he isn't, is they'll abandon the franking system. Very similar to what happened in the UK. Like, to me, it was just ignorance. They had a similar system to the franking system back, they introduced 1977, and that was disbanded, I think, 20 odd years later. So what will eventually happen if Labor's in power, then they'll say, look, the system doesn't really work. Like you're only using half of the benefit of franking because the other half we've blocked it, so you can't use it. Yep. Or it could even be less. So and you really don't get that much benefit. So look, why don't we just remove the system? So then we just go, we're just another player in the world stage. Our financial system is like everyone else. Cyclicality increases. Yeah. The cost of capital increases for all Australian companies. Australian companies don't bother about investing in Australia. They're better off investing overseas. Like Bill Shorten said in 2019 and Chris Bowen, they said, we're going to change the franking system. You should invest more overseas. Like, to me, I don't believe that's the best for Australia.
Yeah.
So to me, it's I am incredibly frustrated, initially angry, and now feeling, I just can't believe how stupid the current Labor Party is being.
Well, Geoff, from an investor's viewpoint, good luck with it because it is worth fighting for. And thank you for talking to Fear and Greed.
Thank you, Sean.
That was Geoff Wilson AO, founder, chairman and chief investment officer of Wilson Asset Management. This is the Fear and Greed Daily Interview. Remember, you should get professional advice before making any investment decisions. Join us every morning for the full episode of Fear and Greed, Australia's most popular business podcast. I'm Sean Aylmer. Enjoy your day.